I expect the price of gold to go up a lot. If that happens, silver price should rise a bit. Gold's making all-time high prices. Of course, in my view, it's really the dollar making new all-time lows.
Right.
So we didn't celebrate it, but we posted about it that the dollar broke down below 10 milligrams of gold. People think, oh, well, gold's above, 3,100. No, the dollar's below 10 milligrams. And we almost hit 9 milligrams and then had a correct. But in gold, the model's spitting out 3,500 right now as the sort of neutral buoyancy point for gold, and $34 for silver.
The speaker, Keith Weiner, notes that while gold recently hit new all-time highs, they see it more as the dollar hitting all-time lows relative to gold. They highlight that the dollar dropped below 10 milligrams of gold, briefly nearing 9 milligrams before a correction. Their model suggests a neutral fair value for gold, around $3,500, and silver, around $34. The speaker, Keith Weiner, an economist, entrepreneur, and advocate for sound money principles, warns that growing political drama, especially around Trump's threats to control or replace the Fed chair, creates massive business uncertainty, paralyzing investment decisions. In this environment, companies prefer to preserve cash rather than take risky bets, anticipating a rough economic period. Tariffs could sharply raise costs, making U.S. industries less competitive globally and leading to layoffs, lower GDP, and rising loan defaults. While Q1 GDP may look okay, much of the activity was pulled forward to beat new tariffs so that Q2 data could reveal real weakness. Ultimately, the speaker stresses that in a heavily leveraged system like ours, everything is fine until businesses start missing payments, then the real damage will show. Let's explore the video in more detail. If you find this content helpful, give it a thumbs up and subscribe to stay updated with our latest videos.
Take over the Fed and essentially command it from the Oval Office. I always say we kind of have the third worst, monetary system, which is we have a debt-backed currency borrowed into existence by a central bank.
Right.
If you want to see hyperinflation, give the president a true printing press where it's not borrowed anymore, no bankers involved in it. It's just print whenever the president, finds it convenient. And then you'll see the hyperinflation that it's not something I wish. And the markets are like, yay, boo, yay, they don't know what to do.
Yeah, it's so uncertain.
Here's how I challenge people to think about this. Everyone sort of who leans libertarian-ish or free market-ish sort of knows the adage that uncertainty, dampens business investment. But I encourage everybody to put yourselves in the shoes of business managers. Business managers are just people. And imagine if you didn't know tomorrow whether there'd be 125% tax. Let's say you produce something in the U.S. and there's some foreign content, but not that much, and probably a 5 to 10 year period before you actually get return on simple return on investment where you pay back your investment. So on that time horizon, would you make an investment if you didn't know whether there'd be a tariff or not, in the near term?
No, it's crazy.
And whether or not we would have a very permissive Fed or not, what the interest rates would be. I mean, you're just going to be paralyzed, because if you have cash, in an environment like this, cash is precious. Ironically, cash isn't trash. Cash is king.
Right.
You might have assets you can pick up, right? So Q1 GDP numbers, that's what am I looking for? I want to see what Q2 looks like, or even some of the GDP now in real-time trackers. A lot of activity was pulled in.
Right.
Whenever the government does something, everybody who's going to be affected likes to pull their transactions in to get them done before the deadline. Imagine if you're in the business of manufacturing stuff in China and importing it. You'd be racing your factory 24/7 to pull everything in before Liberation Day. So the Q1 numbers, anybody who smugly says, no, it's fine, look at March GDP, it's fine to flat, it's up, it's whatever. Sure. Yeah. Anyways, that change happens at the margin. It's always easy, you always see whenever it becomes political that people make arguments that oh, come on, that only adds $1 in cost to something. Okay, you're looking at the non-marginal product being sold to the non-marginal customer and saying that's not going to stop that trade. You're right, it isn't.
Right.
Change occurs at the margin
Right.
as a result of a 120% tariff. And we'll see exactly what the impact of that is, as it plays out. And, my concern would be you get layoffs, right? So for every industry protected, let's say steel, let's say there's 10,000 jobs that you think you can save in steel. I'm making up the numbers. I don't know if that's right.
Right.
It seems probably roughly right order of magnitude in the American steel industry, 10,000. Yeah, maybe it's a few tens of thousands.
Right.
But how many jobs are there in auto making, truck making, ship making, airplane making, construction materials making, appliances? Yeah. I mean, these are industries that use a lot of steel. And if you're driving up their cost, the customer is going to buy less. And a lot of the stuff is produced for export. It makes those companies less competitive. American factories have to shut down. Ironically, the Chinese factories are going to get more business selling to Europe, more business selling to Asia, more business selling to the Middle East, and American companies will be priced out of it if American companies have to pay a tariff on their inputs.
Yeah, and that's not good at all.
German companies don't, and South Korean companies don't, etc. So look for unemployment, look for GDP numbers, and then look for rising defaults on loans and bonds of all stripes. Right, when your business is rendered submarginal, not only do you lay people off, but you may default on your payments.
Right.
Very, very dangerous in a system levered up as much as ours is.
Yeah.
There's an old expression, it's all fun and games until somebody misses a payment. Remember as a kid, was there anybody's mom? There was always one in every neighborhood. Boys, it's all fun and games until somebody puts out an eye.
Oh, yeah.
You're playing pirates with, stabbing each other with sticks or whatever, right? It's all fun and games until somebody puts out an eye. Well, it's all fun and games until somebody misses a payment.
The speaker, Keith Weiner, paints a cautious outlook for the economy and markets, highlighting the weakening dollar, rising political risks, and mounting economic pressures from tariffs and uncertainty. While asset prices like gold signal underlying fragility, the bigger concern lies in the potential for rising defaults and broader financial stress if economic conditions deteriorate further. Investors are advised to stay defensive, preserve liquidity, and watch key indicators closely. How might a deeper correction in Q2 GDP impact market sentiment and Fed policy decisions? What signs should investors watch for to detect the early stages of rising loan defaults? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.